The Adani controversy has been all over headlines lately, and investors are also concerned about a potential domino effect. Should investors be worried and start selling their holdings in Indian equities? I'm Colin, Assistant Manager at IFAS. In this video, I'll be sharing our thoughts on this development and should investors relook their portfolio. For those that are unfamiliar with the situation, let me give a quick run through. The Adani Group is a multinational company and is one of the largest companies in India. It is a diversified corporation with interests across several industries. In late January, Hindenburg Research, a short-selling focused research firm, released a report with allegations against the group on stock manipulation, misappropriate use of tax havens, accounting fraud schemes, and alarming debt levels. These allegations have caused a storm within the Indian equity market as investors fear a potential spillover to India's banking industry if it has a big exposure to Adani Group's debt. This is by far one of the primary concerns for many investors. Global banks like Citigroup and Credit Suisse have also expressed their concern and have stopped accepting Adani securities as collateral for margin loans. At IFAS, our recommended Indian equity fund is the UTI India Dynamic Equity Fund. This is an active strategy by UTI Asset Management, a homegrown Indian fund manager, and the fund invests primarily in high-growth and high-quality companies which benefit from structural drivers within India. Thankfully, the fund has no direct exposure to Adani Group companies. Most of Adani's group companies belong to the commodities, energy, utilities, and infrastructure subsectors, which the fund has stayed away from as the fund managers lack conviction about the ability of businesses in these sectors to maintain healthy balance sheets and generate high returns on capital across cycles. In addition, the fund managers have conveyed their concerns regarding corporate governance for the Adani Group companies. Beyond the fund, UTI Asset Management has little exposure to Adani Group, despite being an Indian fund manager. The firm does not hold any bonds of the Adani Group in any of their fixed income schemes at the moment. It also does not cover any Adani Group stocks aside from Adani Ports. So what about the indirect exposure from a potential spillover to India's financial sector? In short, there is limited indirect exposure. While the fund has a high concentration in the financial sector, mainly through private banks, we are not too concerned as Indian banks only have an exposure of around 23% of the total group's debt. Furthermore, private banks' exposure is below 10% of the total group's debt. It is also reported that private banks only finance assets that have strong cash flows, such as airports or ports. On a broader level, we also see little systemic risk to India's financial system. Based on reports, Adani Group's debt only accounts for a marginal 0.5% of total loans across the Indian banking sector, which is likely insignificant enough to trigger a large-scale risk. Due to the various banking reforms enacted in recent years, the Indian banking system have cleaned up and in turn have become more resilient against shocks like this. Lastly, it also gives us great comfort to hear that the Reserve Bank of India that India's banking sector remain resilient and stable based on its assessment. To summarize, our recommended fund has no direct exposure to Adani stocks. The indirect exposure is likely limited given private banks' smaller exposure to Adani Group's debt. We do not think there will be a wider spillover to India's financial sector and certainly little systemic risk. Major Indian equity indices have also little exposure to Adani stock, ranging from 1% to 5%. Therefore, sentiments regarding the broader Indian equities may sour, but should stabilize once there is greater clarity on the financial impact. Regarding our view on Indian equities, we remain cautious due to the high valuations and the risk of earnings downgrade, but we are keeping it on our watch list due to its compelling secular growth opportunities, just that we do not see the need to pay such a high premium for it at the moment. So for investors who are underweight Indian equities in their portfolios, we advise not to sell as we do not see the Adani controversy as a catalyst worth selling. For investors who wish to seek exposure to Indian equities despite near-term challenges, we advocate investing via a regular savings plan as opposed to investing in lump sum. Through a RSP, investors can align their investment horizon with the nation's long-term economic potential.